How to backtest properly, the 6 key factors. Now, in this video, I'm going to break down, in my opinion, what are the 6 most important things on how to backtest properly. And I've backtested countless systems, years and years and years of data, so many different models, manually backtested, automated backtesting. It's really the framework of my trading. And yeah, here are some 6 key factors that hopefully will speed along your process. These are factors that I've learned along the way that hopefully you can learn from this video and will improve your backtesting and will improve your trading. Because as I said here, why is backtesting so important? Backtesting equals data and data equals confidence. So if you don't have any backtesting data, I'm going to tell you right now, as you collect more data, your confidence in your systems, in your own trading is going to grow. And that is why backtesting is so important. So hopefully I can share some knowledge on how to backtest properly, the 6 key main factors, help you improve backtesting. So let's get into it. So the first thing I want to talk about is defining the rules. Defining the rules of your backtest. What are you going to be backtesting? Let's say you're backtesting a strategy. As you can see here, what are the entry rules? What are the trade management rules? What are the exit rules? And be specific. As I said here, the more mechanical, the better. As discretion gets into your system, the more discretion that's in your system, the less effective the backtesting is going to be. Because there's going to be more margin for bias, more margin for just overall error. And the reality is the end results of the backtest are going to be worse the more discretion that's involved, because there's going to be, influences that essentially make it an unfair test. And the more mechanical it is, the more realistic, the more fair, the more accurate it's going to be to reality. So that's why when I'm doing a backtest, I make it as mechanical as possible. Try to remove all discretion. It's so important. And even if you don't necessarily want to trade fully mechanically, which is fine, you can trade with discretion. But in the backtesting process, you need to make it as mechanical as possible, because that allows for actual results that are meaningful, right? And that actually brings me to the next point. Consistency is key. You need to keep these entry rules, these rules of the backtest consistent throughout the whole backtest. They have to remain consistent throughout, because if you don't, the data is going to be useless, right? And this is something that I used to do all the time when I used to backtest. I would be over here on some random pair, in this case GBP JPY, and I would have some strategy that I'm trading. Let's say I was looking for longs, and I'd take breakout trades, and I'd have my stop loss below the low. And I would do this for 10 trades. And then suddenly I'd be like, well, I keep getting stopped out at, it comes and sweeps the low and I get stopped out. So what if I just put my stop loss a little bit lower, at the following support level, whatever it is, just a completely made up idea here, but whatever it is. And the problem is, it's just, you don't have enough data to conclude that. 5-10 trades is just nowhere near enough data to conclude anything. So if you're going to change it during the backtesting process, you have a completely irrelevant backtest. You've basically just, put some, things on a chart and just played around. You've got nothing of value there. And that's something that I used to do all the time. And all my backtesting was essentially useless. And of course, I've changed that. And it's changed my trading. So yeah, if you're doing this, you have to stop that. It has to be consistent throughout the backtest. The rules have to stay consistent throughout the whole process. Treat it like a science experiment, right? Otherwise, what you're getting at the other end is going to be useless. And again, that brings us to the next point. How many data points do you actually need to consider, to really gain anything of value? Right, this is a really important one. How many data points are necessary? Because I think what I've noticed in the trading community is I think a lot of traders underestimate how much data they need. They think 50 data points is enough, or things like that. And the reality is that's just not enough. 1 month of backtesting, 2 months is not enough data, not even close, right? And so I've put here what's a general rule of thumb, right? Because the reality is there is no simple, straightforward answer as to how much data you need. But a general rule of thumb, I would say, is 3 years of historical backtested data and 3 months of live data. If you can get that, you have a pretty valuable data source that you can actually conclude some meaningful results from, right? But when I say this, 3 years of data, it's backtesting data, 3 months of live data, it does, the frequency of the strategy does matter. Because, let's say, again, back here, let's say I have 3 years of data with a 5-minute scalping strategy, which executes 2 trades a day. Well, I'll have 800, 1,000 backtesting points, whatever it is, if I'm backtesting across a 3-year data, 3-year period. If I'm, however, on the daily chart and I'm trading with some sort of swing trading strategy where I have 1 trade a month, well, I'm only going to have about 40 backtesting points across a 3-year period, or whatever it ends up being. That's not really enough to conclude anything of value. So the frequency of the strategy does matter. And I would say, as again, another general rule of thumb, minimum of 100 data points to conclude anything of value. That's the absolute minimum. Now, the final point here is the more data, the better. The more data you can get, generally the better, because you can start to conclude more things, right? You can analyze more sections of the data. There's just, more information, right? It's better. And that is why I personally code and automate my strategies, which is something I'll show you at the end of the video, or toward the end of the video. And why that really is something that I think is, that's how you get the real data. That's how you get lots and lots of data. And that's how you can really backtest effectively. If you're manually backtesting, the reality is you're kind of, you're pretty limited to how much backtesting you could do. And that's why I've shifted into this whole automation coding area. So I can automate my strategies, backtest them over 10 years of data, optimize them, etc. So yeah, the next thing we're going to talk about is analyzing performance. So let's say now you've defined the rules of what you want to backtest. You've done a consistent backtest over a decent period of time, and you now want to analyze the results. Well, how do you actually analyze the result of a backtest? There's a few different things you want to look at, right? Obviously, net return. How much did it make? How much did it make? And I think a good benchmark to compare it to is, would you have made more holding the S&P 500? Because if you would, then you probably need to reconsider your strategy and aim for a better quality strategy. Because, if you could just hold the S&P 500, it's less work and you might as well just do that. Average trade is an important metric. So the average trade basically means how much is it making per trade, right? And again, obviously this needs to be a positive number. Then you've got the Sharpe ratio, which is basically a risk-adjusted returns ratio. So I'm not going to go into in-depth on each one, but you can look up these key metrics and analyze them yourself. Then you want the equity curve. So obviously you want it to be an upward equity curve, and ideally you want it to be smooth. You don't want it to have huge ups and downs. And then you want to carefully analyze the drawdown periods. If you have huge drawdown periods, generally that suggests that you may have a strategy that is not very good, right? Because if you have huge profits and then huge drawdowns, that's not great. You want something that's more smooth, more consistent than that, in my opinion. So I think what's going to be good here, next we're going to talk about optimization, overfitting. But what's going to be good here is I'm going to show you the TradeStation platform where I code, automate, and backtest my strategies. And I'll show you an example in terms of analyzing performance and everything I've just talked about. I think this will be interesting for some of you to see. So right here is the TradeStation platform, and I've actually put onto the into the the computer. I've put onto the chart. I've put a strategy, right? And this strategy is a Bollinger Band long short strategy. So it's a very, very simple strategy. It's actually given by TradeStation, so you can just take it from TradeStation. And I've just placed it on the chart. And this strategy essentially goes long when the Bollinger Band hits the bottom section and goes short when it hits the top section. And this is Euro USD 5-minute chart. Now, if I come into here and do the strategy performance report, you can see that I have data across a 3-year time span. You can see at the top here from the 2021 to 2024, from June to June. So that's a 3-year time period. And this backtest has 5,135 trades, right? So you can see the power of coding and automating your strategies, because I have 5,000 data points across 3 years to conclude meaningful things from this data, from this strategy. Now, this strategy is actually profitable. You can see the profit factor isn't very good. It's not a very good strategy, right? Even though it's actually profitable, it's not a very, very good strategy, because the average trade is not great. The average trade net profit is not great. We can look down here. We've got the Sharpe ratio. That's a very, very bad Sharpe ratio, 0.07. That means that, okay, yeah, it may have made money, but risk-adjusted returns are very low. And then the other thing we can look at is the performance. This is the equity curve, right? From, again, 2021 to 2024. And you can see it's not very smooth. Up, down, right? And ultimately it made profit. But what's interesting here is if you looked at the first 2,000 trading data points, you would be down, heavily. And then after that, the next, 3,000 data points, we've gone up. This shows me this is not a very stable strategy. This is not a very good strategy, because the equity curve is, not smooth at all. It's up and down. You would have had to go through 2,000 trades of drawdown, basically. This is not a very good strategy at all, right? So that's that. So I just wanted to quickly show you that about, automating, coding your strategies, and how you can backtest them, and really quickly, once you get proficient at it, you can really quickly analyze strategies, look at the key metrics and analyze if they have edge, if they're high quality strategies. And it gives you a level of confidence that I spoke about at the start of the video. It gives you that level of confidence, because I know, okay, well, all these other people are just trading with discretionary strategies, not tested, anything like that. I've gone and I've tested over 10 years of data, and I have some conclusive evidence that this does make money with the historical data. Does that mean it's going to make money in the future? Not necessarily, but it means that it's far more likely to make money in the future, which is the important thing. That gives you that confidence. And that brings us over to the next thing, optimization and overfitting. So let me zoom out here. So optimization and overfitting. Now, this is a really important thing to consider, because you need to optimize your strategies, but then you need to be careful with overfitting. Now, if you're manually backtesting, it's quite hard to overfit your strategies. If you are coding and automating, it's very easy to overfit your strategies. But you still need to optimize, because there may be things you may be putting, you may not have the optimal strategy if you aren't optimizing your strategy. So it's important to optimize. Now, for those of you who don't know what overfitting is, you can see here. Basically, overfitting is when you fit so it's best to show you with an example, right? As it says here, it's a modeling error in statistics that occurs when a function is too closely aligned to a limited set of data points, right? So what that means is basically you've optimized so much that your strategy has basically been perfectly fit to the chart data, instead of so that means it's basically been perfectly molded to that data. So then when that data starts to change and you have the actual live market data, it's not going to be good anymore. The strategy is actually not going to perform as it did in the backtesting. And I'll show you with an example so that you can really understand what I'm talking about. Let's say I have this data point. So this is the daily chart from 2024 till now. That's a decent amount of data. That's 6 months of data. Now you can see the GBP JPY has been trending upwards. So if I just kept optimizing my strategy, just kept optimizing, I'd probably find that a trend following strategy would work incredibly well here, and it would have a high win rate and it would be really effective. So if I just bought all the dips and I bought at a recent high, so I bought the dip when price hit a recent high, and I just kept doing that, again here, blah, blah, blah. I just kept doing that. It would look incredible. And that strategy would perform incredible on this limited data set, because I've optimized until I found, okay, perfect. So there's a trend following strategy works amazing here, buy at the recent highs. But what if I go back and I do that, over here, and I just keep buying at the breakout point, right? So, you have here, and I just buy, and then I start to lose, because this data set is very, very different to the first data set I showed you. And that is basically overfitting. You've optimized your strategy so specifically to one data set that it's become it's perfectly molded to that data set. But then when the reality of trading hits and the trend stops, your strategy is no longer effective. And that is why I think people are so misled by their data, because they backtest on 3 months of data and then they think they have an incredible strategy, and then the market is no longer trending and it starts consolidating or going downwards, and they realize actually their strategy is terrible in consolidating markets. They realize they don't actually have a profitable strategy. And this is why you need to be aware of overfitting. It's hard to overfit when you're manually backtesting, but if you're automating, it is a big problem that you need to be aware of. So this is how you avoid overfitting. Limit the number of parameters. So you don't want to have a strategy with 100 different parameters to get in. Simpler the better, right? In my opinion, simpler the better. That's one way to avoid it. Using a diverse data set. So test your strategy in all types of market conditions: trending markets, downward markets, consolidation markets, whatever. There's so many different types of markets with low volume, high volume. Just test it across various different markets. And that's when you can start to conclude, okay, actually this strategy works. You might not find it works well in all markets. Most likely it won't, right? It might work really well in a trending market. Well, that's great. At least you know that. At least you're aware of that. And you can start to try and identify markets that are trending and then only trade in markets that are trending, as opposed to trying to force your strategy to trade in consolidating markets. And then out of sample testing. Now, I'm not going to go into depth on out of sample testing in this video, but basically what out of sample testing means that you backtest over a time period, and then you take another data set and you backtest on that to kind of confirm. So let's say I have 10 years of data. Well, I might backtest 8 years of that, and then I'll individually backtest on another 2 years of that data. So I haven't overfitted to that, and I've got kind of a buffer, if you will. I wouldn't know exactly how to say it. You just have an additional kind of confirmation that, okay, it's not completely fit to this data point. It also works on this 2-year period, right? So that is out of sample testing. Very, very important in automated trading. So that's how you avoid overfitting. And then finally, to conclude this video, we're going to talk about commissions, spread, and slippage. Now, this is another factor I don't think a lot of traders who don't backtest properly, they don't consider commission, spreads, and slippage. And I'll show you an example of why it's so important. So I'm running this experiment where I'm sharing it on social media, Twitter, etc., where I'm trading with ChatGPT for an experiment, right? You're going to trade with it for 100 trades. It's not doing very well, spoiler alert, but I'll show you an example of where there's certain things with commissions, spreads, and slippage that you cannot factor in a traditional backtest, right? And this is the example here. So in this trade, I went short. Well, ChatGPT told me to go short. I took the short and we got slipped because of some, volatile event. We got slipped from minus 2.8 hours. So that should have been a $100 loss, but instead it's $250. And that is slippage, right? So if I just backtested this manually, let me just go back. If I just backtested this manually, I would have said, okay, I took a loss here, minus $100. But the reality of trading is that commission, spreads, and slippage are a reality. So when you backtest your strategy, it might look incredible on paper, but then you bring it to the live markets and you realize, oh shit, once I factor in commissions, it's not actually profitable. And then once I factor in slippage, it's even worse. And the reality of trading starts to hit. So you need to factor in slippage. You need to factor in that reality. Now, the best way to factor that in is simply to live test. And this is why I said it, earlier on in the video, you need 3 months of live testing data minimum, because that again exposes you to the reality of the markets. Because backtesting on historical data can be misleading if not done correctly. And live testing gives you that kind of got that reality check. So you have to live test your strategies. But yeah, that concludes the video, guys. I'm not going to go too much more depth. Don't want this video to be too long. But as I said, let's zoom out here. Here it is. How to backtest properly, the 6 factors. Define the rules, be consistent with those rules. You're going to want at least 3 years of data, 3 months of live market data. Analyze that strategy, make optimizations, but beware of overfitting, and factor in commission spreads and slippage. If you do all these things and you backtest with large data sets, and if you're manually backtesting, you get as much as you can, it'll give you more confidence. You'll have more proof that you have an edge, and your trading will improve. I guarantee it. So I hope this video helps. Thank you very much for watching.